Okay, so welcome to Quantitative Brainstorm. Today's topic will be complex systems and emergence. I start with a disclaimer. Nothing here is financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek Wong and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. Now that we have all of that out of the way, let's kick off.
All right. This week, Richard posted the equity curve from Mulvaney. It's impressive. Their return over time. It's impressive the depth of their drawdowns and the multiplication of their AUM through time. I mean, from the equity curve. I don't know about the AUM. And it got me thinking. I read an interview on their website. I think it's from 2004, where he says that in their system, they're a trend follower, of course, and in their system, their hit ratio is around 20 to 25%. And I've been avoiding systems with such a low hit ratio. But what do you guys think about it? Maybe a low hit ratio is indeed good enough.
Look, my personal opinion is that when we're dealing with return performance, I think what we are actually seeking is this expression non-linearity in our return performance. So this topic we're discussing today is about complex adaptive systems, and one of the key features of a complex adaptive system, which sets it apart from traditional economics, which views markets as efficient in nature, investors to be rational and homogeneously distributed. In these real markets, we notice that this concept called the normal distribution does describe the bulk of activity in a market, but it expresses it in linear terms. There's a linear relationship between risk and reward. There's this notion that shocks to the financial system arise exogenous to the system itself, but when the system absorbs that shock, it quickly dissipates back to a position of equilibrium. So it's bound in these notions under this efficient market hypothesis, which has been a cornerstone to economics, particularly in the 20th century, to this notion that the system exhibits properties of a steady state, a inherently a system that we can define through statistical tools that highly use calculus as their basis. We understand rational investors to have effectively perfect information, or the ability to access that perfect information. And we realize that whilst this theory has been incredibly successful and has underpinned things such as capital markets theory, such as modern portfolio theory, capital markets, discounted cash flows, it's all inherently based on this notion of evenly distributed variables, independent variables. There's because of this independence of the variables, we've got random walk theories being the cornerstone to the efficient market hypothesis. And it totally eliminates what we as speculators are seeking from these markets, because if indeed that was the case, then there would be no opportunities for speculation in the market. So irrespective of the if you are a speculator, irrespective of whether you sit in what I call the convergent camp or the divergent camp, we all want this not to be the case. We want markets to effectively have non-linearity in them. We want markets to have correlation features within them. So when we look at Mulvaney's returns, we recognise that it's incredibly volatile profile. We all understand that, but the non-linearity that's in the asymmetry of that volatility in the profile is the reason for their very powerful long-term returns. Now, under a more conventional view of volatility as being expressed by standard deviations away from the mean, which is sort of tied to this notion of a Gaussian premise or normally distributed premise, we fail to observe the very important impact of this slight non-linearity in the market data, that when you start compounding that series over time, that small variation, it's a bit like the butterfly effect, that small variation leads to nonlinear amplification, provided that the orientation of that asymmetry and that distribution is to the positive side, the upside. And I think that's what we get with Paul Mulvaney. We get this expression that we can't really look at his equity curve and say, well, that's a highly risky equity curve, because it is incredibly volatile. But the proof of the pudding is that for the last 20 years, he's pulled these superlative returns, but with high volatility. So that's where I'm thinking.
Do you mind if I take a step back for a second? Because Richard, I understand what you're saying, but I think there might be some people in the audience who kind of need to understand what is the basics of a complex system.
Go, Derek.
Sure. So, I mean, I think I just want to start with a little primer. So there are a few examples of what is a complex system. Some of them are in nature. You could think of a forest fire, species evolution, earthquakes, avalanches, and some are by design. And that would account for economies, financial markets, insect colonies, and things like that. And what Richard was talking about and describing was that complex systems have certain key features. One of them being that it contains many agents, is the technical term, but you could think traders, actors, different ants in the colony that interact with themselves and they adapt to the environment. So that's where the adaptive part comes from. They're learning. Another aspect of that is emergent behavior. So what does emergent mean? It means that you have what Richard termed a steady state, or you could call it the normal state. And then something will happen, a shock or an adaptation that will cause it to act differently in reaction to that input. And then I think the third and kind of final aspect of this whole thing is that there's no single point of control for this thing. It's a collective. And this collective, because people can cooperate or not cooperate, or ants can work together or fight each other, or however you want to think about it, creates scale, as in you're changing the scale at which things move. And so you guys can continue to talk about Mulvaney and all of that. It's okay, but I just want to make sure that we focus on this, and I'm sure that you guys would want to save some bullets for tomorrow, maybe.
No, that was a great primer, Derek. Look, just in relation to this Mulvaney discussion and non-linearity, what Derek says is how sort of modern science is now viewing this notion of complex adaptive systems. So prior to that, we had almost a Newtonian viewpoint of a deterministic system, a deterministic universe. Newton used that in his gravitational force laws, where it was seen as a clockwork universe where everything could be predicted because it was totally deterministic. There was no uncertainty, provided we had sufficient knowledge about the state of every single moving part in that system. Theoretically, we could calculate exactly with precision where everything goes. However, we realise with the overthrow of this narrow viewpoint, which was basically Newton's expression from the domain he understood, which was the planet Earth and the associated near surrounds of that environment. And within that context, the model itself proved very successful. It still proves very successful today. However, when you stretch out into a broader domain of higher gravitation or a broader domain of higher speeds and velocities, we find that the rules of Newton break down. And this enforces a wider model, a more applicable model that expresses a broader domain. And in this context, that's where you get the overthrow of Newton's deterministic models of gravity into Einstein's relativity and the concept that space and time are dynamic and the distribution of matter is not uniform throughout that. It's dependent on the concentrations of matter, and the distributions determine the gravitational field, and you get this dynamic interplay, this complex adaptive system. So in economics, of course, Newton led the way with this mathematical notion of this attempt for determinism. And this is great for the financial markets because we all want to be able to predict things with complete accuracy. That's what we want as speculators. So it was very appealing as an economic model when the efficient markets hypothesis came out, because it assumed this arena of steady state, this arena of predictability, this arena where everything reverted around an equilibrium. Everything sort of, the system itself oscillated around an equilibrium. When you get a shock, that shock was soon to diminish back to this position of equilibrium. But I forgot to look at what Derek says is in an actual real system where we've got these individual agents all operating independently, if they don't have full knowledge, they've only got partial knowledge, their behaviour is going to be influenced by their state of knowledge, which is partial. And it's also going to be affected by what their neighbours are doing. So it's not only the individual behaviour or the mechanics of the individual agents. So under a Newtonian model, if we summed up the behaviours of all of the individual agents, we'd get a sum total description that would describe a system of EMH. However, the reality is we see these feedback loops existing in this system where the environment or the neighbours of the agents actually start influencing the behaviour of the agents themselves. So it's not just the notion of the individual agent's knowledge, it's also the behaviour of others that influence the behaviour of that neighbour. And then you get these emergent features therefore arising where collections of participants in that system start exhibiting similar behaviours, often biased, not evenly distributed throughout that system. And that sets up a total change in the system, a bit like Einstein's gravity, which totally changed the nature of how we understand that system to behave. But it was a sort of marginal change because by far the majority of things are very efficient in these markets. But it was these seeds of feedback, positive feedback and negative feedback from the interactions and interrelationships that exist between things in that system. So when you sum total up the individual behaviours, you get a total far less than the sum total of what a complex adaptive system delivers. A complex adaptive system delivers a far greater sum total, a non-linear expression, which is far more than just the independent additions of the individual behaviours of its participants. So this is the nature of what financial markets possibly are. It's a more explanatory sort of notion that sort of serves to identify all of the problems with this notion of steady state. Why do we have booms and busts? Well, complex adaptive systems, they explain that through positive feedback, influence of neighbours, influence of behaviours. Why do we get, some people, acting with partial information or less information than others? Well, that's the nature of how we receive information and the information we learn from others. That's why quant research firms are so successful, because they not only have access to a huge array of widely dispersed information at their fingertips, they've also got incredible sort of research in relation to learning that has been transferred to them. So there is this asymmetry in the decision-making process. And therefore, once you get all of these different decisions, you get this competitive landscape arising, and a fitness function starts coming in to decide which decisions are better than others. So then you start realizing, well, gosh, we've got all of these standard calculus-based probability tools that have been so heavily used in economics. We've got to think of new ways, new tools to start understanding these concepts, and that therefore leads to stuff I'm sure Derek's going to talk about, like Bayesian processes, Markov processes, things that are more computational, evolve in time, adaptive, all of these things. So it's a new way of seeing things.
I'll try to save some bullets for tomorrow, like Derek suggested. But in light of this interpretation of how markets work, in this complex interpretation, I find it hard to get convergent systems. I mean, convergent trading systems, and I feel that if we do live in a complex world, we should strive for the divergent systems. And well, that's why I find it hard to save some bullets for tomorrow, because if we are talking about a complex market, I don't see a different approach other than trend following to approach the markets. One of the key results of these assumptions, of these complex assumptions, is that it's futile to try to find cause and effect in a complex system. And what we should aim our efforts at is in minimizing losses, and try to ride the outliers, try to ride when an emergence occurs. And another question that I bring to you, and I think this point is especially interesting to Bruno, I think, to the other Bruno, is if this emergence concept explains markets, how informative is how informative is past volatility regard to forward volatility? And this connects to a point we talked about last week on volatility estimation and how stable volatility is through time. Perhaps this stability that we have observed is just coincidental. What you guys think about this?
I don't know if we can call it coincidental. First of all, I don't know what happened to Derek. Seems to have dropped out from the room for some reason. At least looking at my Clubhouse feed. But back to Bruno's point. Oh, now he's back.
But sorry.
Yeah, we lost you for a second. Yeah, so back to Bruno's point. I don't know if volatility is sort of unpredictable altogether, and I don't know if markets are in a permanent state of chaos or phase transition. I think the biggest problem and the biggest struggle I had with with everything is finding, and I think I pointed it out a couple of times. It's very seductive to think about markets in this way, but it's really, really hard to see when they, at least for me, when they shift. That phase transition, when things go from being Gaussian, as Richard says, to being highly nonlinear. And so, yes, trend following is a wonderful way of injecting convexity in your trades, in your trading, in your strategies. But I don't know if I certainly don't have a way to understand and discern market conditions. I mean, I touched the other week on hidden Markov models. I've not been able to use them. I've not been able to diagnose ex ante the state a market is in. I don't even know how many states a market should have to begin with. Likewise, space state models, they are very difficult to make work, at least in my experience. So these theories are all very right in theory, and it's not a play on words, but they're very difficult to apply. So what are we resorting to is either Jerry's incredibly powerful simplicity, which is you take your trades and forget, and sort of. But the problem with that I have is that you have to divide up your capital in two buckets, which doesn't make much sense to me. Or the other way is we go, we turbocharge everything and we try to build this super model, which for me it doesn't work. So I'm really stuck between a rock and a hard place. But I understand, what people's desire to do better at modeling. For me, it's a problem of measurement rather than a problem of framework. But um, I'm obviously not smart enough to solve it, and not smart enough to sort of influence collective behavior.
Yeah, Bruno, look, this whole notion of complex adaptive systems, the more I dig into it, the more I realise to a degree that it is almost it's a futile exercise trying to optimally develop better and better models, because inherently there's this notion of stationarity in that assumption. Under this moving feast that are these complex adaptive systems, I personally think we've got to strip back to simplicity. That is our only chance of being able simplicity and degrees of freedom, provided they're asymmetrically orientated. Because I think you come back to the broad basics of what is characteristic in these markets. And the important thing is we know that trends are an enduring, persistent feature. In fact, let's be nice. Okay, there are two forms of speculation that exist in the market. There are convergent methodologies that operate on the assumption that price reverts to a mean or an equilibrium. This is this basis of oscillations or price excursions diminishing towards a mean. But then there's the non-linear extensions on the left and right tails of the market distribution that says that, well, there are these tail events, and these tail events are transitions, market phase transitions, however we wish to call it, which break up this predictable pattern. So really there's two broad forces at work in the market. There's this divergence and convergence. When we get a blend of the two, we get noise. There is no signal, but there clearly is this tendency towards equilibrium and this tendency towards non-linearity or tail extension. And this changes the nature of this normal distribution to what they call a Tracy-Weedham distribution, which is a peak with tails. This is inherent in almost every physical complex adaptive system and biological complex adaptive system. So we shouldn't think we wouldn't find this as well in these financial markets, which is another example of a complex financial system. So this therefore means, well, this is a morass, a minefield. How do we develop models that can navigate this very uncertain, unpredictable domain where periods of predictability interdispersed by these punctuated periods of disequilibrium with these major transitions? And I think this is where Jerry is right. We've got to go back to simplicity. We've got to go back to a simple asymmetrical system expression that provides these constraint boundaries to our adverse impact and leaves opportunities open for what we know exists in the market, that tail events are much more frequent. For instance, a 5 sigma event. I think that under a normal distribution, a 5 sigma event occurs every 7,000 years, but we see this occur almost every 3 or 4 years in the real market data, every boom and bust cycle. 5 sigma events, very commonplace. So we know that these outliers are significant in number, highly distributed, and they're just. This is where a price follower says, these things occur. This is the mechanics of a market. I'm not going to try and predict anything about or assume anything about expected value, because expected value is based on a cornerstone of a Gaussian distribution. We can't do that. There is no such thing as expected value. But what we do know is there's asymmetry in the market data. We therefore need an asymmetrical system, which is simple. It provides degrees of freedom for noise to play out. But that's as good as we can get, I personally think.
I think Tracy Weedham distribution is a good point because it is a crossover function between a weakly and strongly coupled components of a system. And I don't think anyone actually believes that anything is a normal distribution. I think it's well known that markets are not. I think that people use it as a simplification, but I don't think any practitioners out there using it. The question I think that Bruno is asking is there a way to detect you're at that critical point, to detect that you're at a transition between the weakly and the strongly coupled? What does that mean? It means everyone is moving together or everyone is doing different stuff. And when and in the trend following world, we like it when everyone's moving together because that's creating the trend. But really, it's between kind of two distributions. The one where everyone is kind of on average doing their own thing, and the one where people are all coordinated and doing things together. I guess my bar analogy didn't get that across, but that idea that not necessarily it's one fixed distribution, but we go from one to another, and that if you can accept that that one is another, then you can look for criteria that it's happening. I haven't found. Okay, so in my personal research, I have not found to a critical point detector. I honestly think that it's probably a holy grail type thing. However, there has been work done both by Mandelbrot and Deirdre Sornett to detect these second phase, where you will be looking for those tail type distributions. And that happens specifically, and it comes back to this the nonlinearity in the price action, which I will distinguish from the nonlinearity of a complex system, when power laws occur. So when things are moving exponentially, that is a telltale sign that you are no longer in that normal playing field, if that makes sense. That's my understanding.
Yeah, but is it better to interpret things as in a, just to simplify things here, as if we have two states, one when everything is quote unquote normal and the other when things get exponential? Or is it the case that we're always in this exponential phase? It's just that the mode of the distribution is pretty common. We most of the time we see tiny variations of price, and sometimes it goes wild. But the data generating process is such that it's not that it changes. It's not that we have two states. It's one single state where sometimes you're in near the center of the distribution, and sometimes you're really far apart. I believe that I tend to go to the second case, where I think there is only one data generating process, just one state of the market, and sometimes, and I don't know when it is, things will get really wild. Things will get price moves are gonna get exponential, and what I tend to focus my efforts on staying alive to 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 be able to ride these moments, and not try to predict when one thing will change to the other, when one state will change to the other. Because just like Bruno said, these models are pretty tempting. They're really beautiful to see. They're nice to understand and to develop, to model things this way. But it's incredibly hard to put that to work.
Yes, Bruno. This comes to the age-old question of, there's things called tipping points, which we have this intuitive feel for, that there are these tipping points where we get a system phase change from one distribution into another, but they're just so incredibly hard to identify
Yeah,
because of the
exactly.
multivariate nature. So
Exposed is easy to point when that tipping point occurred, but ex ante
yeah.
it's impossible.
And so, this comes to the question, well, is it worth, as Alan Watt says, is it worth the candle or the effort in trying to identify these tipping points with preciseness? And I personally think until, Derek might know models that can achieve this, but I certainly don't. I certainly know things that are better than others, but I certainly don't know how to nail down when these phase changes or regime shifts occur. So, yeah, that's hopefully what we can uncover in this brainstorming session.
I can give an example of two. One is more philosophical, I guess, and one will be more practical. So, if anyone here is familiar with Nopit's Lily Francas, her work on identifying these points where the gamma is very high in options and the hedgers are forced to do something, which means they're working in a coordinated fashion, is an identification of a tipping point. And it is an identification of where the average participants, these market makers, will move in a coordinated fashion. And then that will trigger more people to move in that fashion. It may trigger margin calls or something like that. The more kind of we can take a step back and just think about normal kind of trader or whatever. Um, when a stock market crashes, there is some point where people start getting margin calls. Those margin calls push into more margin calls and hit more stops. Um, that is evidence of empirical that we've all experienced what happens in crashes. Tipping point, identifying the right price, okay, that's like a different thing. But I do agree that the specific models that come out of this theory are better for understanding how groups of traders work and how to find the point in your mind, where things might happen. Whether you can come up with a model like Lily Francas is a totally different thing. She's a genius all-star. But it does drive behavior, and I think that that's what I'm really coming away from. We can step back to trend following for a second. Not knowing why things would occur, or not understanding what's the underlying process that's making this happen to me, I think, well, obviously I have this curiosity, but it's like maybe some people don't need those answers. But if you did understand what was the underlying process, you could focus your attention a bit more. Creating a predictive model on top of that is a different thing.
Yeah, I agree with you, Derek. I think it's very useful trying to bury into the underlying mechanics and the reasons for these things, simply because it makes us exceedingly aware how important risk management is, because the many paths of uncertainty sort of ensure that we've got to have that at foremost front of mind. But our ability to usefully extract information that can give us this additional edge, this is the incredibly hard part. But we have track records of these things. We have track records of the performance returns of fund managers. And I think that speaks so much louder than what a statistical measure can do, because it gives us this performance track record where we can see, and this is why I often say, all right, divergence are superior models to convergence. Now, what I'm not trying to be mean here. All I'm saying is that this nonlinearity in the market distribution through these tail events delivers bigger bang for buck on a pound for pound basis from a risk reward perspective when we trade divergence. And what I'm saying here is that as soon as we integrate some form of convergent measure into our divergent model, we are sacrificing that asymmetry that's produced in those long-term performance returns. Because the real secret sauce to all of our efforts is really this miracle of compounding. And compounding is a path-dependent metric. It depends on the path of those investment returns. It depends on whether we've had these extreme drawdowns in the past. It depends on whether we've captured these outliers in the past. The actual path itself is optimally configured with divergent models, which gives that extra nonlinear amplification under compounding. So that's where I think that we can talk about ergodicity if you want, but this is a non-ergodic process, which investment finance is a non-ergodic process, because under this principle of ergodicity, there is this embedded assumption that any point or any movement of price in an ergodic system must, over a lifetime of that system, visit all points in that domain space. Now, we know that that's not the case. We know that financial markets are non-ergodic, particularly a wealth series, because if we have $100,000, we don't have a symmetrical distribution, positive or minus, to that $100,000. We've actually got what they call an absorbing barrier at $0, which means that that vast array of possible potential paths that under an ergodic process would go below zero actually get stumped by zero. They get nailed. And that automatically injects asymmetry into our investment return path. So we need an asymmetrical approach to this asymmetry that exists in our return path. And that's where this, I feel, a superiority of divergent models, particularly trend following, gets that added juice to, say, the convergent premise.
This is an awesome conversation. I'm really learning a lot and hearing everybody's different perspectives. And I would really say I'm a bit of a novice compared to you guys. But one thing that did come to mind was I don't remember where I heard it from, but one trader said it that trends are a function of time. So when it comes to identifying tipping points and following trends, both of these ideas seem to be constrained by a time factor. Uh, I'm not that familiar with cyclic analysis. Um, I'm aware that it exists, but I haven't studied it. And I was just wondering if anyone had a perspective on how time plays a factor in both trend following and identifying tipping points.
Okay. I will try to do Richard first, and then I'm writing down notes for Daquan. I obviously I'm going to take the other side of this argument, Richard. I don't think
I'm getting
that.
used to it, Derek.
Yeah, I know, and I think that this is the kind of the brainstorm together. Fund managers having long track records, capturing trends, which we can call emergent behavior, just proves it's capturable. It doesn't necessarily mean that it's that's a total different argument, because the world works on convergent systems, convergent models. I don't think anyone would argue that having a portfolio of U.S. Treasuries, even for the last 100 years, there have been ups and downs, but that is a convergent strategy, and your money would have been safer there than in any other place, and it would have compounded. So the issue with the return series, yes, I understand there's an absorbing barrier at zero, because if you're broke, you can't play. But I don't think that's necessarily talking about what we're trying to capture in a strategy position. Most banks, most market makers, most of these people are running trillion-dollar businesses doing convergent behavior. Now, it's about what we, the trader, want to do. And, it kind of goes back to my point earlier. The market is better when people have different preferences. And having that different preference may allow you to create something a bit different that fits your needs. Um, Going into what Daquan was saying, talking about cycle analysis, I have tried a bit of that. I forget who is the author, but he likes to use like a lot of sine waves and stuff. The book was maybe 15, 20 years old, maybe. I don't know, maybe not that old. Elhers, maybe. And if you believe in this cycle analysis, and then it goes back to this Mandelbrot, and part of what the complex adaptive systems theory, at least from what I've read, Mandelbrot is a big factor in that. So in fact, it won't matter what time frame you're trading, because the tipping point will be in whatever time frame that is, in proportion to what that time frame is. So if you are able to find a tipping point on the 1 minute bar, it will move exponentially in the 1 minute scenario. But if you find a tipping point in the daily or the weekly bars, then it will move exponentially in that series. So it's fractal, as in all of the different times you're looking at will have their own tipping points, and they'll all be scaled to that um, time scale. I mean, time frame. Time frame is the word I'm looking for. Yeah, I hope that helps.
Aside from Misbehavior of Markets, do you suggest any other books from Mandelbrot or any special paper?
No, I'm not actually that familiar with his specific papers, other than the book you had just mentioned. But on that same vein, I do think the work by Dieter Sortnet, which is detecting bubbles using power laws, is quite interesting, because he ends up giving you a formula that can detect when these bubbles are occurring before the crash happens, because things went really exponential and cannot be sustained. So he's approaching it that he couldn't find the tipping point ex ante. The tipping point has occurred. Things are going crazy, and then it's like there will be a correction, and so it's like the other side. It's a convergent trade, of the opposite of the trend trade kind of thing. This is not the trend following, thing, but there is, his book is quite interesting, and it will allow you to at least get a framework to measure when you're in like the normal mode versus when you're in the non-normal mode.
In this group, you're allowed to talk other than trend following.
I told.
No, you're
I know
not.
Jerry's just listening to us. He's in the group just judging us, but that's fine.
No judging,
Go.
just but I'm enjoying it, so thank you for having me.
Listen, one of the things I thought that is interesting is now this is in physical systems, which I think are applicable when we look at financial markets, and this is this concept of noise reduction through extending out to longer time frames. So you'd be aware of the fact with Mandelbrot that there's a scale-independent feature of fractal geometry. We've got these outliers occurring in this series that otherwise might be a noisy series. And what you find at the very low time, so if we have a small number of participants, say in the very short-term time interval space, in other words, a financial market is an unbound, but it's an asymmetric system. In other words, there is a 0 point, which is the bound constraint of that financial system, and then there is the open-ended nature of that system. And when you put traders together and they interact in a trade event, they create a tick. So we have this 0 point, and then we've got a slow progression of more and more ticks consolidating into a framework. Now, initially, there is a high degree of noise. There is still outliers in that series at that small time frame. But what you find as you step out to longer and longer time frames, you get destructive interference of the noise. Now, this is a feature associated with the correlations in that those distributions. So we could imagine if we overlay two random series together, because random series are by definition uncorrelated with each other, this uncorrelated nature of those two series actually dampens the noise of those two return streams. So you could imagine as you step out progressively to the short term, to the medium term, to the long term, you get this progressive dampening of uncorrelated noise, and you get an amplification of those outliers that are present at all scales of the market, but they amplify, they're additive. So that is why I feel that we've found the trend following community have progressively had to slip out to medium to longer term. It's the same principle that you find in sound engineering when you have these noise cancelling headphones. So what they do is the noise cancelling headphone goes on your ear and it records the external noise to that headphone. And then it injects an opposite or an uncorrelated noise into your headphones to actually cancel that noise. That's exactly what's happening, I believe, in financial market time series, and why we need to step out to the medium to longer term if we want to capture divergence. But if we want to capture convergence, it's the reverse. You want to go down in the series towards the higher frequency end of the spectrum, because the convergent model is based on this premise of this equilibrium. And we find that in a noisy time series, upon entry into a noisy time series, there is, by definition, more chance of you being stopped out with a profit as opposed to a loss. Irrespective of the signal, it's the noise that actually gives you a slight benefit there. So there's a benefit to noise with convergence, but noise is a real problem with divergence.
Okay, that's interesting. The mixing of the two distributions, random distributions to interact. Like I imagine that one distribution is for the buyers, one distribution is to the sellers. Going into the small time frame, I was just at a talk yesterday by Alvaro Cartea. He's one of the, I think, one of the best writers on high frequency trading, and he says that even now, ticks are predictable up to 40 milliseconds, and considering people are working in the microsecond space, it's almost an eternity. It's not necessarily because he's looking for the noise, but I don't think that the traders are independent. I think that these distributions of what people want or even their actions are affected by the collective, and that can be represented by price because that is the end result of the collective of what everyone has done. Going out further in time is an interesting thing as well. I haven't studied it specifically, but my intuition would be about these tipping points. And the further out in time you go, the more people's tipping point you will have triggered, causing larger cascades. And that is why, even if you are trading, say, a multi-strategy man style strategy, you will still catch those extremely large trends, even though they have the convergent bit in the middle. So you can imagine like they have the convergent strategies in the middle, and then if you go further out, that's like the trend strategies if you're the multi-strategy, and they're losing that bit in the middle of the trend catching. But at the further time frames, you're able to get more to that edge where even they need to switch over from convergent strategies to divergent strategies. And then that collective pushes it forward. It almost is like moving farther in time is a higher probability of engaging the herd, triggering people's herd to buy and having FOMO, or triggering them with fear, on the downside, and then that kind of collective action compounds on itself.
Fractal geometry you guys talk about, I think it's an excellent metaphor for markets, or an excellent way to view markets, because when we are far apart, when you're looking at annual plots or monthly plots or even daily plots, they look pretty much the same, and that's why I think there is a fractal structure on it. But as you zoom in, when you go to minute plots or millisecond plots, like Derek said, there is a threshold beyond which things start to look well behaved, normally behaved. And when we use this fractal point of view, I don't know the word, sorry guys. When we use this word, this fractal framework to analyze coastal lines, like Mandelbrot did, it's kind of the same. And when you zoom in really, really hard, you go to the grains of sand, and then you find some structure that's explainable, better explainable. So Derek, you talked about this talk you did the other day with high frequency guys. Do they use these normal models? Because in their space, I think it's better to use them. And I'm connecting things you guys just said. Perhaps when we are on a really, really short time span, normal distributions are fine. But if you step out from that, then we start to look at these less well-behaved distributions. What you guys think about it?
Don't
Bruno,
tell
just a
that to a
quickie
market
before Derek
maker
goes.
on the wrong side of the market. Sorry, Jerry. Sorry, Richard.
Sorry,
That's all right.
Bruno?
Look, I was just thinking someone who used fractals quite highly in their trading strategy was, of course, Bill Dryce. So Dryce Research had an amazing, stellar track record, quite a sight to behold. He used this concept called the fractal wave algorithm in his trading process, which was a basis to consolidate the zigzag of price moves into fractal geometry, which then ultimately defined trend directions. So the way that structure of fractal geometry was put together, it basically gave a signature of trends, probably a bit like Elliott wave to a degree. However, the way fractals operate, of course, leads to this emergent structure, which is considerably different to the original behavior or mechanics of that fractal. So, in these complex adaptive systems, they don't have rulers, they don't have clocks, they have a self-repeating, repeatable rule that is used, that accesses local resources to apply that simple rule to develop structure. So you get a fractal mechanics, evolving into a nautilus shell, or these amazing emergent structures, which are so different from the actual mechanics of the underlying behavior. And that's because it's the emergent structures that evolve in a complex adaptive system themselves form the foundations for future emergent structure. So what you find in these complex adaptive systems is that whilst they are behaved to obey the laws of the physical universe, because they are a system contained within that universe, so the possible states that complex adaptive system can exist in must obey physics principles. However, the nature of the fractal generation of structure and emergent form is everything that is possible within those broad rules defined by the laws of the universe. So there's this amazing variety and complexity that exists within that fractal architecture. But I just thought it was interesting that Bill Dryce could actually use fractals as a basis, the fundamental basis for these 30-year stellar performance returns.
To answer Bruno specifically about the HFT, no, they don't use normal distributions. They use a lot more machine learning because there's a lot more data. And also, interestingly, they don't live in temporal time. What does that mean? They don't live in minutes and hours. They live in information time, which is like you could imagine a trade. There might like a tick. One tick might occur once, and then 10 seconds later it takes another. Or the less liquid it is, there's another tick, maybe 20 minutes later. Something could be really illiquid, or you could get tens of thousands of them a second. And so they are existing in a totally different realm that allows them to use more of these statistical techniques that doesn't work on like a daily time frame, just because of a low sample size. I mean, if you can imagine we had 10 billion years of daily data, then maybe we all could do it. But because they're generating, I think it's like 20 gigabytes of data, for a trading day or something like that, they are just in a whole other realm to allow them to use modern ML methods.
Fascinating. Thanks.
Yeah, I was going to say, Bruno, that you shouldn't tell a market maker that gets caught on the wrong side of the market that, at very, very low time scale, things look normal. And so he could use that normal distribution assumption. And the thing that Derek pointed out, and I think, I don't know, but I think we're sort of diverging from today's topic a little bit if we're talking about very low scale market making and very high frequency trading. But the point is once again looking at what is time, and in what dimension do we live? As Derek was saying, are we trying to capture events, or are we every day doing something? Two things that lead to very different answers. But back to today's emergence and linear dynamics and all of that. I think it would be really good if we could try to understand whether it's better to use a simpler model, even if we don't agree with all the assumptions, or is better to try and build something more articulated and complicated and try to make it work, because I'm completely lost. I mean, again, I said I don't like Jerry. Well, I don't like him. Of course, you can't argue with success, but I'm saying that I have a big problem with Jerry's assumption in breaking up equity or capital in two buckets. But it's a very simple assumption, and his model works. We talked about very complicated models. We're talking about Mandelbrot and so on, that neither of which are traders, neither of which, to the best of my knowledge, made any money trading the market or successfully. And there are ideas which are mathematically very the way above my head. I couldn't really understand most of what Sonet's early warning systems and things like that. But I tried to replicate them. Obviously, it failed. They're very difficult to calibrate those things. And yeah, they might work once, and then they can get to write a nice paper about it and get lots of people, rolling the red carpet before them. But the following day in the market, they might not work, and they might lose a lot of money. So how do we strike that balance? Because I'm utterly lost. And in my experience, and we touched a bit last week, with Derek's seal of approval, using a Bayesian framework allows you to correct some of the problems, Bruno, that you were pointing out. So you could still start from making lots of normal distributions about in your priors, and then use MCMC to work out a posterior distribution that fits market data, even if the underlying market data is not normal, it doesn't obey a normal distribution. So shouldn't we try and kind of follow this type of tools, this type of approaches, and have a slightly simpler model, but trying to improve on that? Or should we just embrace this new wonderful branch of science that looks about complexity? I mean, the Santa Fe Institute, Richard was talking about it last week. I mean, they've done amazing work on that, but none of it, I think, is applicable to our world, at least in my very, very limited and very irrelevant experience. And so all the things that Mandelbrot and Didi and Sonnet do, and they're very, very difficult to make work. So I don't know where the balance is, and maybe Derek, I'm sure, has got some some ideas about it, and I'll be very happy to hear.
Sure. I mean, if I do believe in Occam's razor. I think that if you are trying to capture emergent behavior, trend following is and breakouts and all of that kind of stuff will do it. Um, that is a simple, proven way to do that. I think that um, trying to predict the tipping point is another thing, and obviously for me, I think my research process does involve reading a lot of papers and seeing what works and what doesn't, but also having an understanding of why certain things should work and not, and instead of just throwing things at the wall. Um, the Bayesian approach, for Bruno C's comment, I mean, you guys know that I do use that approach, is a way to become adaptive. And I think that we know that the generalized assumptions that we have in the market, we all know that those are not true, what they teach you in the CFA or whatever. We also know that I think the most important thing I take away from complex adaptive systems is not the complex part. It's that they are adaptive. The people in the markets are smart and they will learn. And the tipping point that it was this time will be different than the tipping point it was last time, but there will be some kind of trigger. And if you are looking to trade within the tipping points, a convergence strategy, then you must be aware that it is the collective action of the group suddenly working together that causes you to lose money. And on the flip side, when you do go through this, tipping point, um, and people are all of a sudden work together, that is when the trends will appear. Now, um, I think that's taking it very to basics. And if you can apply that in a much simpler framework than all of these papers that have come out and just distill it to that idea, then I think we have something to work with. Because the question now, and I think that's getting back to what Bruno P was saying, is how do we use this to make money, right? What can you do today or research today? I mean, I can't say do anything, no recommendations, blah, 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 but what can you add to your mental framework, your mental models, or come down with an idea? And I think the first step is having some kind of adaptiveness in your system. And if you have an understanding of what could trigger certain repeatable phenomena in the market, it gives you a much closer first principles approach to creating whatever that indicator is. So that is why I think that the academic work is so important. Not necessarily the formula that they give you in the paper, the idea, take out what is that phenomena, and then refactor it into something hopefully simpler that will trigger that. And I think that, going back to the previous example, that longer time frames are better. And then my thesis that at longer time frames you're hitting more people's critical points, whether that's in a down market and you're triggering more margin calls, or in up markets the bandits of crowds and FOMO. Then that's how we can think about things.
I tend to not get too caught up with going down the rabbit hole for any particular process. So I like taking a very high line, highbrow view where I'm trying to sort of connect the dots between research papers to basically sort of uncover a general principle. So I personally think the best we can do is identify these general principles that you find embedded in the results of white papers and all of these things. So, clearly we've got some general principles like diversification of uncorrelated return streams is an excellent principle. Things such as restricting your trades to eliminate your ability to overtrade, because overtrading is a classic where this goes against the grain of a rational investor. When you're overtrading, that means that you are trading within the noise. Now, under this perspective of a rational investor, well, they clearly wouldn't be trading in a noise. But what's actually happening is that that speculators are treating noise as though it's actually important information. So that sort of once again cuts across the whole basic premise of EMH. But trade away from the noise. Be selective in your trades. Wait for volatility expansions or non-linearity to be clearly evident before you strike a trade. I think those general principles are probably the best we can do without going too far down the rabbit hole and locking ourselves into something that we might never get out of once you go down these deep, deep burrows.
This is true, but if we are doubting that volatility is specified as we specify it, i.e. by standard deviation, if we are doubting that certain tools are useful in guiding our action, if we're questioning premises and assumptions, like it comes to a point where we're not doing science. Well, not that we are doing science, but we're entirely into pseudoscience and superstition. So I'm trying to strike a balance. I mean, hopefully I'm coming across more as a pragmatic practitioner rather than just a guy that wants to always argue the other side. But I'm fascinated by this debate, but at some point you have to sort of program systems and you have to take trades. So where where is this boundary between fascinating theories and blood, sweat, and tears, which is the practice of trading? I mean, does anybody have any ideas about that?
Well, I clearly look at the performance returns of professional fund management firms. So, we can see an equity curve or the performance track record of a fund. Now, I'm interested in something that is non-random, something that has a demonstrated long-term track record, and then I'm particularly attracted to these incredibly smooth equity streams we get from, or these portfolio returns we get from the likes of TransTrend or Man Evolution or the Evolution Fund or the Alpha Fund, and that to me is where I investigate. Well, what are they doing? What is the secret sauce they're applying that's different to, say, Paul Mulvaney's model, which is much more volatile? They are still trend following, but they're doing something different, and I think there is inevitably simplicity in their systems, but I think where they are going is they are going into these alternative markets. It's a bit like what Harold de Beer was saying about trending markets. He makes you widen your scope to see what does it mean by trending markets. Most of us think of just the common liquid financial markets, but this investigation into these alternative markets that offer a far degree of sort of less correlated regime to these traditional market sectors. I think that's where we're starting to see this sort of the filtering to the top of those fund managers that are very selective but incredibly diverse across these uncorrelated market sectors. I think that is something worthwhile pursuing from a practical sense, like you said, Bruno. But I use a track record to do that. I don't use statistics or I don't use the results of a white paper to tell me that. The first thing I want to do is I want to see a validated track record. If I can see that validated track record, I know how to guide my search without going down this useless rabbit hole that never leads anywhere.
Let me give you an example, I think, a toy example, as always, of a first principles approach that is easily understandable. So you were talking about volatility, so I'll use that as my example, and I'll use equity markets as kind of the basis. Imagine you're trying to decide whether or not you're in a high volatility regime or a low volatility regime. It's extremely complicated. You could use any of the Arch-Garch family. You could have 20 different kinds of ways to calculate. volatility, some using intraday data, some using only closed data. If you use the standard deviation, you're making an assumption. Now, simply put, we are just trying to classify one or the other. And imagine we decided that we were going to research a Garch model, and then we were trying to fit it, and then we were going to try to use some kind of HMM or whatever ML you want to decide. But very simply, we're just trying to find a regime. And in equity markets, we know that how the volatility behaves. It's mean reverting, and it has big spikes up and these types of things. So simply put, you could have a 1 year average of the volatility, and if anything is above that or below that, it's a regime, and that will get you actually very close to what you're trying to do. Do you want to improve it a bit? Sure. You can also keep it simple. Say I want to add a z-score. Okay, so I know that the volatility is biased towards the downside in equities, so I want to kind of increase the hurdle rate where it will become a high vol environment. So you say, okay, so anything from say plus half of a z-score and below is normal regime. Anything above for that day is a high regime. And you could actually backtest this. And if you went long flat as that kind of system, you will have actually kept yourself out of some of the most volatile days, as well as some large drawdowns in the S&P 500. So that's where I'm coming from with any of this kind of academic work. You can use Occam's razor. You can determine what is the underlying fundamental reason why people are thinking about things this way, and then work backwards. What is the simplest expression I can do that has a high correlation to the phenomena I'm trying to measure? Does that make sense, Bruno?
It makes a lot of sense, but obviously being being the guy that always plays devil's advocate, you are back into a realm of uh, normality assumptions, standard deviations, and things like that. And for full disclosure, that's how I do most things as well. I mean, my only sophistication is because I've discovered how important, how powerful some of these inference mechanics could be. I'm trying to use, when I don't know how to do things, I resort to the inference button, and I just let things loose. But I completely understand what you're saying. I'm also, I also feel obliged and compelled to say that, well, such a simple approach then cannot possibly be reconciled with, emergent behavior, chaos theory, nonlinear dynamics, and so on and so forth. So, I mean, it's a very pragmatic, a very, useful and fruitful, I might say, approach. But it's definitely not academic, and it wouldn't, it wouldn't make Professor Mandelbrot happy. It wouldn't, you couldn't bring it up with DDS or net at a cocktail party and all of that, because they would always look down on you and say you're an idiot because the world is not normal and blah 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 blah. But I completely get it, and I think is the is the answer that we should settle for if you ask.
I mean, I think my point is that when you have that basic building block, you can make it as complicated to the not normal as you want. I do think it is coherent with emergent behavior and the actions of others. If you did assume that most people are trading convergent models, if you want to take it this simple idea instead of a z-score with a standard deviation, you could just do a percentile. That is a non-unit based thing. You could say if it's on the percentile basis or a quantile basis to set your thing. And in fact, you have kept it just as simple. You're just calculating what is the percentile of today's volatility versus the past year. And you have removed that assumption. So I think it's about simply removing the error that you're trying to get rid of. It doesn't mean you necessarily need to have complexity, but you very much need to understand what it is you're trying to measure, or what it is you're trying to exploit. And if you cannot get to the first principle, then you cannot apply this practical method.
And I guess this is my critique, and again, I'm a nobody, but is my critique to all these complexity-based models. They are fascinating and wonderful. They really explain how the world works. But if I can't tell the regime I'm in a sort of strong mathematical framework, what the hell am I doing in playing with all these nonlinear dynamics and all these parameters that when I don't even know how to call regime A versus regime B. And sorry to go back, but Bruno C was pointing out whether it's part of one single environment or it isn't. My understanding of nonlinear dynamics and um, uh, complex-based models and agents is actually that it's not. We are in different regimes. The most prevalent is a normal one when everything, when almost a Gaussian world, and then we veer off and we just move away from it and we come back and then go off a different one and things like that. So it's really important for these models to work. It's really important to time your shifts. And an analogy I thought about is like if we were completely blind and we couldn't read the thermometer, and we had to tell when water starts boiling, the only things we could do is either listen, so hear for sound when it starts bubbling up, or put obviously a glove and insulate your hand and feel movement around your hand. And I think as an analogy of market, it's the best I could think of. But we cannot see a data generating function. We cannot see a regime. We only work in latent space, and we can only sort of capture and try to abstract things away. So our biggest problem is that I think, it's the world we live in that forces us to make relatively simple assumptions, and as Derek was saying, complicate them and strive away from complexity, because complexity brings out all sorts of nonlinear effects. And initial conditions are very important in complex systems because in complex systems are by definition very sensitive to initial conditions. What does it mean? It means that in a complex system, if you start from a point and apply dynamics, you end up in another one. But if you start from in a different point and apply the same dynamics, you end up in a different place. So it's very dangerous to use very advanced models in markets that are certainly non-stationary, certainly heteroscedastic, and all of that. So it's I'm a fan of those things because they're nice in theory, but I think it's almost impossible to get anything out of them.
I know where Bruno's coming from. It's our very nature that we want to understand how things behave, and it's our very nature that we want better models. We want to be able to find some research edge that gives us this extra bit of nudge. But that there is another way of looking at it as well, and that's by saying, well, we know that the nature of human nature itself is that the vast proportion of investors and speculators think this way. So you can almost say, well, there's our delineator. If we take the counterpoint, if we take the different view that markets are not predictable and stable, doesn't that mean in a zero-sum game with less players participating on the other side, like divergent players do, that there's going to be a flow of wealth towards that player? Do we have to be very clever in getting better models, etc., or is that sufficient to generate this edge that over time with compounding does all of the heavy lifting? Are we striving for something that is just ephemeral? Too tough to achieve, and can we simplify our statement back to a much more simple one that simply says, let's predate on when predictive models fail?
I think it's very interesting because this is the tension for any research, right? Taking an idea and then making sure that it's applicable and then having the confidence to execute it, whether it's the original that was published or someone told you or you learned from experience. but making sure that that research is persistent, right? And I find that I think that this conversation, we're seeing how everyone thinks about thinking, I would say, or thinks about research. Um, but going back to the main premise, are we playing to play or playing to win? And absolutely, I believe everyone in this room is playing to win. We are not doing intellectual masturbation, or at least hopefully not, um, to try and determine a smarter way to make less money. So, in a world where there is more uncertainty, in a world where there are complex interactions between things, it's better to control things that you control. And that's where you control the parameters, you control the simplicity. Why is that the case? Well, first of all, you can use, like a hammer, or a dagger or whatever your tool is, a blunt one or a sharp one. But if you get a similar result, it's better to use the easier one. The question is to determine um, how much is that one complexity worth? Two, is it worth the lift, the research lift? Because trying to implement that might take a lot of time as well. That is opportunity time that you could have been spent somewhere else, you know. And we all have a limited amount of time and resources to put our teams or ourselves to collect the data and to do all of that. So I cannot say that I defend complexity. I don't. What I can say is that there are many ideas out there that can be simplified, and the potential cost of simplicity is the loose pants fit everything. I know people say that all the time, but it's like, if my assumptions can fit inside this circle, or I'm taking a bad assumption, but most of the time it's inside this, it's acceptable. So, what is that level of acceptable error you're willing to take versus the acceptable level of complexity?
Love that loose pants, Derek.
Yeah, I agree with you guys. Perhaps I think I'm as pragmatic as Bruno P is advocating, but perhaps I don't know, a bit nihilistic about how how much can we understand about markets, and that's why I focus most of my time in trying to find ways to stay alive and uh, and be able to ride the outliers when the big moves come. Um, I find this complexity theme interesting, and I think trying to put these models within our systems is beyond the threshold Derek was talking about. What I do find is important is for us to get the main findings, the consequences of the consequences of these systems if they're true. And one hugely important consequence for me is exactly this point of, don't try to explain too much why things happen and how far they can go. Just ride the train.
Hi to everyone. This room was a little surprise for me. I saw it accidentally and very happy that I'm with you. And I want to say that I had a lot of research about complex systems. I thought that they're maybe more effective, and after that research I understood that complex system at least have the same result, theoretical result, as a simple that is less complex. So it's a very best situation, and average result that complex system that I have personally tested, maybe not all of course, maybe I'm wrong, but my result was that complexity will give problematic way of executing and have a problematic way of robustness.
I think Oleg hit it. And I think we all are practical in our understanding. Most of the things that come out that we see on the internet will be very marginal gains, right? But I mean, I know I'm talking to a panel of trend followers here. So um, the idea that you can capture 90% of what you're capturing with these emergent behaviors in the trend following is fine, because that extra 5% comes with maybe an increase of 20% of complexity. And that is where the trade off becomes really bad. What I think for me personally is that um, I haven't been able to, how do I put this? I haven't been able to find what's that balance yet. And I think I'm coming down from the mountain of complexity in my own trading journey, which is where that first principles idea comes from. Being able to distill the intent of complicated systems, to replicate them with, say, 80 or 90% or less, but it could be 70, but a majority of that taken out, and putting back some of the assumptions that potentially they were trying to get rid of, like this normality. But the cost trade-off is I have reduced my complexity a lot. So I think trend following is a very special case. I think it's a generalizable case of strategy development, especially in convergent strategies, market making, HFT, structuring. They will require a lot more of this type of work. But that's not necessarily that they aren't doing it as simple as they can either, because the question of robustness is a looming one that we face every day the time we open up our backtesting platform, or any day that we are deciding that we want to try something new. We are contaminating our data. We are adding mental bias for the next strategy we trade because we've tried it, and we probably won't try a similar idea again if we know it's bad. And so, how do you manage that part of the process and make sure you are capturing like the amount you can as simply as you can, and live in that world where at least the assumptions you're taking, why this will break down. I think that is a great place for the business aspect of running a fund, is that if you are taking the simpler strategies, if you are taking the simpler assumptions, you can explain to a common lay person why it did what it did. And maybe after they've been with you for a few years, they will understand what your strategy does. So they can anticipate when it would do badly, and you're not getting that phone call, when they get a bad monthly NAV. And so there are definite intangible upsides to the simplicity, and the cost of that is purely just leaving a bit on the table.
That's a really good point, Derek, because I think for me personally, one of the hurdles that I've gotten over is recognizing biases in assumptions. And I think that's where this discussion is really helpful to me personally. The How do I separate my analysis from my execution? For me, it is recognizing what are the factors that dictate my execution. If I'm looking at a trade, what are the factors that I'm considering that are going to tell me that this trade has a high probability occurrence? And so that's where analysis comes in, because I have to do the analysis before I execute. Otherwise, I'm simply trading randomly. And the conscientiousness of bias is something that, unfortunately, I don't think we can ever really get away from. And I would almost go so far as to say it's one of those things that drives the market. If someone has a bullish bias, and that bullish bias spreads like wildfire, everybody's following the trend, and you know, we'll say that the majority of participants are benefiting from that. So recognizing bias is a one that's an act, as it's even more of an active process than it is analysis, I think, a lot of times, because for me, I stay on the psychological side of trading the most. Like, I love analyzing, and execution is so instantaneous that I really don't think I put too much time into it. But when it comes to bringing it all together, for me, it's, I can look at my data that I've gathered, as far as I can at this point. I can tell the difference in what stop methodology I use, whether or not I use a stop loss or a trailing stop, and that'll tell me that I'm thinking from a different psychological perspective than the most objective one available to me in my limited capacity as a trader. And so, it is, step one is gathering that data, gathering that data and doing the analysis. And I think that starts with the own individual's behavior, because I think the biggest benefit of looking at complex systems in the behaviors of market participants as wholes is that you get to figure out what their assumptions are, and you get to figure out what their biases are, and you get to trade those. I think it was John Carter that said, "You never trade the markets; you just trade other traders." And I've always really liked that, because if I figure out what someone's bias is, whether or not they have a preference towards complex or simple systems, or if they have a preference for mean reversion or trend following, figuring out what people's perspectives are, interests, biases, all these things are going to help my decision making process. Because if I go to ask them, "Hey, how do you see this?" then that'll hurt me. That'll help me figure out whether or not I actually think I believe the same thing. Because I've had several times to where I'm like, "Oh yeah, I'm a trend follower," or "I'm a day trader," and those turned out to be circumstantial at best, because it was a bullish day in the market, or I followed one trend out of the whole week, and I'm like, "Oh yeah, no, I'm this thing." But it's a matter of measuring the consistency in your process. I think that's going to be the determining factor, because, like I said before, execution is instantaneous. But doing the we'll say the groundwork to preparing to execute, it's challenging. I think, anyway, for me, I think it's challenging, but I also think it's manageable. It's just a matter of being aware of it. If you're aware of it, then you could figure out and begin to ask the right questions. Are my assumptions leading me to make better trades or worse trades? I ask myself that question, and I think about what my results are, and I have to question if these are actually the results I wanted. Sorry, that's kind of long-winded, but thanks for letting me share.
No, I think that was a great point. Look, I think this notion that investors have partial information, I think that's the key, because what that says is that there's a domain of knowledge associated with each investor, and that domain of knowledge is partial. It is not full. So outside that domain of knowledge, we've got this area called uncertainty, and that exists in these financial markets. So what you're saying is that when we get this partial information, a general consensus on this partial information, we can therefore get a bias in the market. We get this maybe a bullish consensus for a long period of time. Almost like everything goes up, and I think really what that boils down to is, it says to me that really our emphasis at all times simply needs to be on risk management. Really, it's about letting the market do its thing for the upside, but managing risk at all times. That to me is coming down to this principle of robustness. It's a survivor in all possible conditions, well, as many conditions as you possibly can get, because we are all victim to uncertainty. But there are certain models that are better than others, and really, I think that boils down to risk management, as opposed to how to profit better in these markets. I think it really is a case of, well, how do we manage risk better in these markets?
Duquan said something very interesting, and there's two aspects, and I wrote down one is the self-reflective trader, detecting their own bias, and like you said, that is a self-mastery thing. But that you're aware of that and that you are working on that, I think is something that we all as humans, whether we put an automated system between us and the markets, we are always having some kind of bias and influence there, and just being conscious of it is a really good step. But the other quote you said, you were trading other traders, kind of gave me an idea, and it's not just people have biases, institutions have biases. And that is actually something that you might want to look into. Example, I think it's JP Morgan. Every quarter they have a equity index collar strategy that they roll, that moves the options markets because they are price insensitive. They just restrike and enter at the close. I think it's the biggest option trade that happens every quarter. It's $20 billion or so. They need to do that for their clients. They have a bias. You have ETFs that need to rebalance at the end of the day. That's an institutional bias. You have people who need to cut their losses because of margin calls in spiky environments because the risk manager taps them on the shoulder. That's an institutional bias. So, in fact, it's meta. I know it's a meta thing, but it doesn't just apply to you. And because you're trading other traders, you're also trading other institutions. And finding that area where they have bias is always an interesting place to look. And you may find repeatable things there.
And there's I get this kind of self-reflection from this game. It was called the Coin Challenge game, and you could just Google it. It was something that a couple of finance professors put together, and it's literally just a game of heads and tails. And but the probabilities are fixed. So the probability of occurrence for heads is 60%, tails is 40%. And the professors presented this game to their students as just a small micro test. And what was really interesting was how few individuals could actually play the game. I believe you start off with about $250, and your goal is to get to $2,500. And I played this game for maybe 2 years. I kid you not, 2 years before I actually realized that it's like Richard said. It's about risk management. I don't need to go all in on, let's say, the probability of me getting heads 3 times in a row, because that's going to increase my risk to ruin. The way that I played the game, when I finally figured out how to, was in order to play so that the best way to play so that my risk to ruin is absolutely 0%. And for that, I calculated what is the largest amount of money I can lose with a 40% risk to reward ratio, or with a 40% loss rate, sorry. And once I actually got the dollar amount, I realized that if I stay at this fixed amount, I could never lose the game. And it was really strange. I understand it's just basic math, but I think what makes, at least this is what I love about trading so much, and investing in understanding behavioral finance. It's really propelling, because yes, it is just math, but for most people, it's math combined with their emotions. And emotions are inescapable if the mechanics and the structure of the game aren't understood. So, thank you, Derek. Thank you, Richard.
What you said about emotions and maths is exactly right, and that's a point that Ole Peters was making on this non-ergodic economics. This path dependency. So you can have this random game, 60% win, 40% loss. The expected value, of course, shows that over time you should have a considerable profit, a linear ascending expected value. But the reality is that as your wealth changes, your decision making becomes more or less risk averse. So you don't apply that maths. Your emotions come into that maths and significantly disrupt that expected value. And this is where this bias comes in, risk management comes in. You get a totally different path under all scenarios on a non-ergodic basis than the traditional way we view things in terms of expected value. So your point is really valid, I think.
Perhaps this is the biggest change to our models. We should, as Ola Peters suggests, move away from quadratic utility and recognize that utility changes depending on where you are. Probably when you're talking about losses, you might have a quadratic or exponential utility, but gains should follow a log or sublinear utility function, and they should adjust all your models based on that. This is something that interests me a great deal. I haven't done anything to adjust my optimization functions or anything like that to figure out how to apply it, but it's an interesting.
And I get remembered, like in one of the episodes of Top Traders Unplugged, Neil said that first of all, Down Capital in its research think about risk, about controlling the risk, and we can't. He said that we can't control the profit, we can, but we can control the risk, and first of all, we do this, and it's very important to understand for.
I love how I end these calls with a lot of homework.
By the way, yesterday I was speaking with one trader, a stock market trader on the streets of St. Petersburg, and he asked me what do I think about his system, and I said that the system looks like a chair, broken chair, and we don't know where it will fall, and it will be sooner or later. It's not an unfallen system. It's something about penny stocks, maybe. I don't remember exactly. But I said, if you have good risk management, your chance is much bigger. And even in a very good system, even theoretically, if we have a best system in the world, and we have a wrong way of doing risk management, this system will be ruined. Even the best system in the world, best strategy, will be ruined if risk management is in a bad way.
Well, it's coming almost on to an hour and 45 minutes. And at the end, I think we should wrap up, but also I want to take suggestions for next week's topic. If anyone would like to suggest some topics.
I think I might be a little biased in the suggestion, uh, but the relationship between the math and the emotions, I think, will be a good topic. Simply because emotions tend to override the math in a lot of cases, um, and I think probably a summary of experience where one benefits the other would be a good review.
Well, now you've put that suggestion up, you're going to have to be a key speaker. You know that's the game we play on this clubhouse. So yeah, I unfortunately said I knew something about complex adaptive systems, and Derek decided to throw me into the deep end. But I think it's your turn next week.
Sounds good. I'm looking forward to it.
Thanks everyone for coming. See you next time.
Thank you, everyone. This has been great.
Thanks, guys.